to buy your stock, okay, that you are selling. Okay, so just like Siti Nurhaliza lah, right? Siti Nurhaliza want to promote her album. She has to do a roadshow. Okay, so if she do not do the roadshow, how are people are going to buy her albums, right? Same lah. Okay, that is my analogy. Siti Nurhaliza supposed to be guys. One. Okay, these have investment bankers because demand for the offering which help them to set up or to set the initial offer price. So basically, if you want to know what is the price of the stock, you have to look at the demand. Okay, we have the supply, and we do not know what is the demand. So when we know the demand from the potential investors, we can always visualize, okay, what is the initial price of the stock. Okay, because normally price could be the price of the share could be obtained from the equilibrium of the supply and the demand of the stock, right? So basically, if you have the supply, which is the stock, and then you have the potential investors who like to buy the stock, you can always obtain or visualize what is the offering price would be. Okay, so this is one reason why they would like to go for a roadshow and to see what is the demand from the investors. And then after that, the underwriters set the terms. The Securities Commission must approve the offering. So there are a lot of procedures actually you have to go through in in issuing your shares. Okay, a lot of procedures. If you want to read more about this, you can always go to the Securities Commission website or KNSC and then browse. Okay? Browse the website. Okay, there are a lot of information in there. Okay. Now we look at the investment bankers rule. Okay, the most public offerings are made with the assistance of the investment bankers. No, I'm not saying that all. Okay, I'm not saying that all public offerings must be with the investment bankers. Okay, but most, majority. Okay, majority are with the assistance with the investment bankers. Okay, which are the financial intermediaries that specialize in selling new securities and advising firms with regard to major financial transactions. There are the experts. There are the experts. So they assist the companies to go for public. And then the main activity of the investment bankers is underwriting. Okay, underwriting is actually involved the purchase of the security issue from the issuing company at an agreed on price, and then bearing the risk of selling it to the public at a profit. So what the investment bankers will do is that, okay, they will go to the company, okay, and then they buy it at a price. Okay, for example, RM1 per share. They buy at RM1 per share, and then they go for roadshow. Then they see that what is the price they would like to be, and then after that, after they know what is the offering price, they will issue and get approval from the securities, then issue the shares to the public, IPOs, right, at the price of RM2. So RM2 minus RM1 is the profit of the investment bankers. Okay, but they are also facing the risk of the shares not being sold, okay, which is under subscribed. Okay, basically, you know, under subscribed is the share which will be issued but not being taken up by the investors, by the public. Oversubscribed means that people who are to buy these shares are so many that it is more than what the shares which are being issued. That is what we call oversubscribed. Okay? Continue on with. Underwriting syndicates are typically formed when companies bring large issues to the market. Okay, not only syndicate haram, that is syndicate, okay, but bankers also have syndicate. Okay, bankers also have syndicate. They are called syndication. Syndication actually normally occurs when there is a big loan or big issues being big issues being offered to the public. For example, 50 million shares issued. Okay, so they're so big. If the bank, one bank, underwrite the issuance alone, the probability of the shares not to be sold is high also, right? So if the share is not being sold, what happens to the bank? The bank will go bankrupt. So in order to reduce the risk, what the bankers do is that they call all of the bankers. For example, RHB Bank call all of the bankers, OCBC, BCB, okay? All the bankers to sit down together, okay, and then discuss about the syndication. So what they do, they will finance certain percentage. For example, BCB finance 20%, okay, and then BIMB finance 30%, and so on. So the risk is being eliminated or being reduced, okay, if you do it under syndication, okay, right? And then look at this is each investment bankers will syndicate normally underwrite a portion, okay. So I've mentioned before, maybe 20%, BCB 20%, okay, and then BIMB 30%, and the rest 50% might be come from the bank, okay. So a portion of the issuer only. Okay? The syndicate does so by creating a selling group which distributes the share of the investing public. So what they do is that they will create a selling group, or what we call, in other words, if you look at supermarket, they have the promoter, right? Okay, to sell the product, right? But these also are using the same thing, right? If you are in marketing, right? Marketing major, this syndication also must create selling groups or promoter. Okay? This will be shown by this diagram. Okay, so this is the issuing corporation, the company, and then this is the syndicate. Okay, investment banker, BCB, RHB, BIMB, okay, Bank, and so on. And then this syndication will create the selling group or the promoter. Okay, this selling group then only will go will sell this to the public. Okay? Or to the purchasers of the securities. Okay? Now we look at the cost of investment banking service. Okay, investment bankers earn their return by profiting on the spread. I've mentioned before, they buy at 1 ringgit, okay, and then they sell at 2 ringgit. So the differences is called the spread. Okay, the spread. Okay, the spread is the difference between the price paid for the securities by the investment banker and the eventual selling price in the marketplace. Okay, the purchase price minus the selling price minus the purchase price. Okay, before selling to the market. Now, in general, cost for underwriting equity is highest, followed by preferred stock, and then only bond. So the highest cost is common stock. The second one is preferred stock, then only bonds. That's why some companies would like to issue bonds instead of equity, instead of common share, because of the cost is higher, the highest in terms of cost. Okay, in percentage terms, cost can be as high as 17% for small stock offering to as low as 1.6% for large bond issue. So you can see that these are a big difference here. For stock, 17%, of course. Bonds, 1.6%. Okay, so this is the research which has been done in US market. Okay, you might want to do a research in the Malaysian market. Okay, you guys, you have to do it. Maybe next time. Okay, interpreting stock price quotation. Okay, now if you look at my handouts which I have given to you last time, okay, handouts from Business Times, right? Okay, that is actually a stock price quotation from the newspaper. from the newspaper. Okay, that stock price actually indicates a lot of statistics for the public to look at and also to evaluate whether the stock is good or not. Okay, so if you look at this, okay, this which is from the textbook, this is sample of the stock quotation from the New York Stock Exchange. What I have given to you, okay, is the stock quotation from the Kuala Lumpur Stock Exchange. So it looks different, right? Looks different. They look different from each other. So basically, if you look at the stock quotation, you are being given the high and the low here, right? In that case, high means that that is the highest price of the stock that year. Right? The highest price of the stock that year. The low means that is the lowest price of the stock in that year, right? So we have also the name of the stock, okay, the name of the stock, and also the stock code number, okay, stock code number, and also the dividend yield, okay, dividend coverage, okay, market capitalization, and also the closing price and net changes in terms of percentage, also in terms of dollars or ringgit. Okay, percentage. What is the price changes from yesterday, plus or minus? It will be given in the stock quotation. Okay, so the price increased by 3 cents, or the price increased by 5%. Okay, so that is important for you if you are a stock market player, because you want to know what is the value of your stock, increase or not. Okay, you look at one advertisement, right? One advertisement from, I'm not sure, Nam Sina, right? Actually, you are actually buying the stock, and then the stock goes up to 650, and then you want to sell it, and then you can buy anything lah, because you have profit from the capital gain. Okay, a friend of mine who would like to play stocks, almost every second or every minute, he would like to check the stock price. Okay, nice and good. Almost every minute, stock berapa ringgit. So you are not. It's okay lah to play stock, but it's better for investment rather than speculation. Okay, investment is better. Investment, you buy it today, and then you want to keep it for 1 year or maybe 2 years. So you are investing in that company. But speculating is you buy today, then you're hoping that the price will go up, maybe in 3 days or 5 days, then you want to sell the stock. So you can get capital gain from that. Okay? So it's different. Okay? When you want to talk more about the stock quotation, you might want to go to www.klsc.com.my, go for investors, click on investors education. Investors education, and then also click on the interpreting stock quotation in the newspapers. Okay, you click there. There are a lot of information about in that website. Okay, a lot of information. Okay, now we are continuing to the second lecture which we are supposed to cover this week. Okay, stock valuation. Okay, we have finished about the theoretical part of the stock. Okay, how to value the how to issue the stock. Okay, how to underwrite the stock. Okay, now how to value your stock in the market. Okay, how to value your stock. Okay, stockholders expect to be compensated for their investment in the firm shares through periodic dividends and also capital gain. So these are rules. Okay. Because they want to get returns in terms of dividends and also in terms of capital gain. Okay, this is a two income from holding stocks: dividend, also capital gain. And then investor purchase shares when they feel that they are undervalued, and sell them when they believe that they are overvalued. Okay. Undervalued and overvalued means that what is the market price and what is the real value. Okay, so you will always purchase when it is under value, and then we will sell when it is over. Okay. Now market efficiency. This is a very important theory in the stock market. Okay, market efficiency. What is this theory is all about? Right? So basically, investors base the investment decision on the perception of the asset risk. Okay, we base on our investment, whether to buy the asset, whether to buy the stock, based on the risk. Okay, what is our perceived risk on the shares? So this is our decision. That is our investment. So in competitive market, the interaction of many buyers and sellers will result in an equilibrium price, the market value of each security. If you look at the volume trader, for example, in our stock quotation, volume trader, we look at NTEC. Look at NTEC, how many volumes, how many shares are being traded? 30,000, right? Over than 30,000. So basically, one individual might want to sell it at 4 ringgit and 80 cents. Other will have to sell it at 5 ringgit and 50. So what we do is that to derive the market share, the market price, you will have the equilibrium of the demand and supply. Then you can get the market price. Okay? So we are not saying that everybody is buying at 4 ringgit 80. Somebody might be buying at 5 ringgit. Somebody might be buying at 3 ringgit. Okay? But the equilibrium will be your market price. Okay? So the price is reflective of all information available to the market participants in making buy or sell investment decisions. So basically, the price will, the theory says that the price actually reflects information of the shares. Okay? The price actually reflects the information of the share. Okay, the information, for example, the financial standing, the board of directors, and all that, right? So the price actually reflects the information. Now let's see an analogy. I'm giving you an analogy. If you want to buy a book, okay? If you want to buy that book, you have to have the information. What is the contents of the book? Who are the author of the book? Who is the publisher? So these are the information that you would like to gather, right, before you buy the book, right? So it's the same as shares. You would like to know, okay, who are the issuer, what are the risks. So all the information are also being transparent to the public. Okay, information will be the same. Okay, for example, you all will have the same information about the stock that I am going to issue. Nobody will have the privilege, pilih kasih. Okay, pilih kasih. Okay, you dapat soalan exam, you dapat tahu soalan exam besok. No, everybody will have the same. So that is market efficiency. It's the same as macam tu lah, right? So basically, that is what we call market efficiency. Right? Okay, look at market adjustment to new information. Okay, the process of market adjustment to new information can be viewed as in terms of rate of return. So basically, when there is new information in the market, okay, the price will adjust accordingly. Okay, the price will adjust accordingly to the information. For example, if the company is facing a legal action due to some negligence by the employees or not, okay, what they do is that the price will go down. Okay, the price will go down because the risk factor has gone up. So these risks actually correlate with the rate of return. Okay, risk and return is actually correlated together. Okay, high risk, high return. Low risk, low return. So basically, when we are talking about rate of return, we are also talking about risk factor. Okay. Whenever investors find that the expected return is not equal to the required return, okay, the price adjustment will occur. Okay, so basically, if you look at this, the expected return is not equal to the required return, we will see that price adjustment will occur. Okay, if expected return is greater than required return, okay, K hash, okay, higher or greater than K, okay, you can see that investor will buy, okay, and bid up the price until new price equilibrium is reached. Okay. So when we buy, what happens when we buy? The price will increase, right? The demand. When the demand increase, price also will increase, right? In the economy, right? When the demand is lesser, the supply is higher, the price will go down. So it's the same as this. When K has expected return is higher than K, okay, people will buy. Your expected return is higher, right, than your return. Okay, so investors will buy the shares. Okay, the opposite will occur if the required return is greater than the expected return. Right? So if the required return is greater than the expected return, people will start to sell the shares. Okay, so we start to sell the shares. Now we look at another important theory in the stock market, efficient market hypothesis. Even though I do not agree with this theory, but we have to learn. Because sometimes some of the theory I do not agree, especially EMA, efficient market, all that theories, right? So, because it is too simplified, make things too simple. Actually, things are not simple in the market. Okay? Not simple, but this is for knowledge. Okay, the efficient market hypothesis, which is the basic theory, this is the basic theory describing the behavior of a perfect market, especially, okay, so it's actually efficient market hypothesis describes the behavior, tingkah laku efficient of a perfect market. A perfect market, what will do? What the perfect market will do? Okay, basically, the perfect market will always say like this: securities are typically in equilibrium, meaning that they are fairly priced and their expected return will equal required return. So K has been equal with K. So this is their theory, basic theory. Okay, efficient market says K hash will equal to K. The expected return equal to required return. So this is the theory. And then secondly, at any point of time, securities full reflect the price of all the public information, okay, available in the market about the firm. Okay, basically there is no insider trading. You know what is insider trading? Insider trading. Insider trading is actually traders, right, who are trading in the market, in the stock exchange. They will contact directly the firm and ada tips ke? Bagi saya stoknya apa ke ni. They contact the company itself, not the advisor, the company itself, whether the company is launching a new product. Okay, so they will get information faster than the public. Okay, so when they get information faster, they can get profit, right? So basically, in the efficient market, we are stating that all the information are readily for the public. Okay, and also these prices will also react quickly to the information. Okay,